our trading strategy. This is the Joat Divergence Trading Strategy. It is basically a simple strategy that just uses two confluences, right? And when we talk about the Joat divergence, it's basically a reversal strategy that we use for multi-factor confluences to spot reversals in the markets. So when you're using this strategy, you basically just look to sell a buying market or buy a selling market. So what are the confluences that we use? We use RSI indicator at the period of 14, and we use a trend line. We don't use anything more than that. But then there are also other factors that you will have to look into the strategy. So then we have to look into what the conditions are when we have to make a trade. So there are two conditions, right? The condition one, when you have to buy. And in this condition, you first have to look at session timings. What are session timings? This is basically the period in which you are trading. Okay, either you're trading in Asian session, London session, New York session, because the time that you trade will affect the result of your analysis and the result of your trading outcome. Number two, when you are buying, we look at price action. We look at the trend showing the lower lows. This is just market structure where the price is breaking the previous price level to go down. And on the indicator, on the RSI indicator, we look for a trend that shows a lower high. So meaning that as the indicator is going down, it shows that it's also trying to go up. We'll see more indication of that in a live market and examples as well. And then we go for the opposite, when to sell. It's basically the same again with session timings, knowing what period you are trading in, whether Asia, New York, and London. And I'll tell you the times where it occurs in our time zone at UTC +2, because session trading and session timing is very important for you to know how much volume is in the market and when are the big investors also looking when to take in their entries. And then I think I made a mistake here by having another 1 year, but let's consider it as point 2. You need to look at price action when you want to sell, because when you are selling in a buying market as a divergent strategy, because this is a reversal strategy. So you are looking to catch for sales in the opposite market. So when you are selling when the market is buying. Either it buys it was buying and making a retracement, or it's fully going to reverse into the opposite direction as a sell. And then you look at the price action showing higher highs, while at the indicator trend, you look at the indicator making higher lows. So here's an example of how the market is when you have to buy. So this is the low talking, and then another low. So this purple line is denoted as your trend line. So you connect your trend line onto the trend showing a lower low. So this low here, and then the second low, because this structure, this price level was broken by another previous price level showing a consecutive low. And then you look at your indicator. In this case, this indicator is called a stochastics, but you can use stochastics or RSI, and I'll show you the live market, how you can use this as well. You look at first, this is a setup of a buy. So as we said in our rules, when to buy, you need to look at the price action trend showing a lower low and the indicator trend showing a lower high. So in this example, the price action trend is showing lower low and the indicator trend is showing a lower high because this low is higher than this previous low. So it's basically, it should show opposite slopes on both sides of price action and the indicator. And then you should look for either an engulfing candle. What an engulfing candle means is a buying candle that's bigger than the selling candle. That's when you enter the market or you enter with a buy, and then your take profit comes to the next structure high. That is a way much more conservative approach into when you're buying the market, when you are looking for buy setups in a divergent market. Now we look now to the next scenario when you have to sell. Right? When you have to sell, obviously you have to look first for your session timing, know what time it is that you are trading, so that you may know whether whether it is realistic for you to enter the market, because this is a very crucial period for you to know whether you're gonna have enough volume to go with the trade. So then now, when you're looking at the selling scenario, we said you have to look at price action showing higher high. So you can see this is a structure showing that the market is going high, and then we see another structure showing a high again, which is higher than the previous one. So this is what you call a higher high market structure. So then after you have identified that and identified the period that you are trading in, you look at your indicator. What is it showing you, right? It is showing you a lower high on the indicator, a higher low on the indicator, meaning that this structure here shouldn't be lower than the next structure that's forming here. So in this case, it's almost as equal. So when it's equal or lower, you can use it as price confirmation. But then in this case, it looks more equal and higher a bit. But then with this one, it's also kind of tricky. So at the end of the day, you need also to look at your timing and your sessions. So this is just one of the examples. We can look again into the next example, which is much more clear of a sell setup. So that we can see that we have a structure here, which is high, and we can see it's a bullish trend, which is a buying market. This structure was broken down and we had a peak trading of formation until this point, and you can see this point is higher than the previous point, right? And then on the indicator, this is now what we are showing on the price action. On the indicator, we can see that this original point is higher than the next point. So then this gives you more confirmation to say that you can likely sell the market. So you look first, because now how you guys can tell that your setup is matching is if you look at the indicator at the point where the divergence are touching and the price action, you'll notice that the candle forms and tells a story on the indicator as well. Like you can see at this point, and at this point here, they are forming a story to tell you what the market might anticipate doing. And then the confirmation comes when you draw divergence, and then you look on both the indicator side and on price action. And then you decide how to take your trade. So when you take your trade, as you are selling, you take profit to the next structure, to the next support, which is down below here, and you would have made your profit depending on your risk to reward ratio. Now we can also look into it more with the bullish side, which is the buying market, which we said that price actions should show lower lows and the divergence should show lower highs, as you can see here. So this is a lower low and this is a lower high. This is a lower low and a lower low. And you can see these points are matching price and the indicator. And you take your trade after either an engulfing to the next structure high. You can have different types of take profits, and you put your stop loss just below the previous low when you buy, in case trade validates, so that you can manage your risk properly.